level, but stocks like M&M and Dr. Reddy's have been doing pretty well for themselves while IT takes a backseat today. But in this volatile times, how should you place your bets in the markets? Let's try and find an answer to that. We have been joined by Siddharth Vora, Head of Quant Investment Strategy and Fund Manager at Prabhudas Lilladher. Hi Siddharth, good to be speaking with you. Definitely volatile times for the markets, but firstly help us understand that what are the recent changes that you have made in your portfolio, and at given this volatile period, how are you placing your fresh bets?
I think what we've done over the last, I would say, 2 months roughly, is we already had a high quality and low volatility bias in the portfolio for the last 8 months, roughly since July 2024. Our models have been signaling us to move out of momentum, to move out of value, and go into quality and low volatility. So I think from a style perspective or a factor perspective, we continue to remain focused on low volatility and quality. The bigger changes we've actually made is in the sectoral composition. I think for the last 18 months, we haven't owned much of the high quality private lenders in India. I think private lenders, high quality lenders now become a significant part of our portfolio. Other than that, cement has been also a new addition as a sector in the portfolio over the recent times. Agrochemicals, fertilizers, and chemicals, again absent from the portfolio for the last 18 months, have now started gradually making a significant allocation in our portfolio over the last 2 months. So I think in terms of sectors, there has been some change in terms of which sectors do we now own, which sectors are we overweight. We've gradually obviously reduced our allocation to pharma. IT is underweight from being overweight, though we still own IT, but it's a underweight position now. Consumer staples and discretionary also, I think we've pruned a little bit. We've rejigged a couple of stocks there. Times are volatile for sure, but I think right now the opportunity is in the near term to protect as much alpha on the downside or to protect the drawdown on the downside. It's tough to really get absolute returns in markets like this, where I think 70-80% of the stocks in India are correcting on a monthly basis, on a quarterly basis. So I think our focus remains to curtail volatility, to manage drawdowns.
Point taken, and this is Nehi also joining in the conversation. Just want to get back to you on your point of adding lenders to your portfolio, and you're very overweight on these names. Could you tell us if these lenders are banks? Are you positive on NBFCs? What mix do you have when it comes to the lending space? And even if it's banks, is it because of valuation comfort? And if so, are you liking private versus PSUs? Could you just give us a lowdown on what this lending portfolio, the lending part of it, what does it look like?
So it's broadly names like Kotak Bank, HDFC Bank, ICICI Bank, Bajaj Finance, Cholamandalam, Bajaj Holdings. It's the top tier large cap high quality lenders in India, which from a quantitative perspective are showing signals of relatively low volatility, relatively more comfortable valuations, long term track record of quality within the sector, and decent growth outlook as well. So I think when I look at growth, quality, valuation, and volatility, these sectors sort of come in the right pockets within the quantitative framework that we evaluate in the current scenario. We didn't have some of these names, say, for the last 18 months because there were other pockets with relatively better, growth, relatively better valuation, relatively better momentum. But in the current scenario, when our focus is only on low volatility and quality, I think these are some pockets which could help us, save the downside erosion going ahead.
But Siddharth, in this correction, and especially in this recent correction, no sector is actually left behind. You talk about some of these safe sectors, what you call it, be it IT, pharma, and even for a matter, even other than that, what we have seen is that all these sectors are facing tremendous pressure. Definitely, there's a lot of news flow, not just in the domestic market, but globally, of course. But give us a sense that in this quite a volatile times, which sectors look more vulnerable to you and you believe that one should stay away from at this point in time, at least?
So what's happened in the market is that the market structure has changed completely over the last 10 months roughly. We were a buy on dip market. We were a market that was buying bad news, ignoring bad news on the way up. Now the structure is a sell on rise market. We are also selling good news. Bulk of bad news is already out. Lot of new fresh triggers, whether it's from budget, whether it's from management guidance, whether it's from the rate cut, whether it's from order book sizes or order book wins. There are a lot of new good news that's been coming in. And if you also track the whole earnings upgrade and downgrade cycle, I think over the last 2 quarters, bulk of the downgrades, whether it's in terms of growth or in terms of multiple, is behind us. This quarter, we've actually seen more upgrades than the last 10 quarters, which means from a growth and valuation perspective, the street is saying things are looking better now. The opportunity is
Okay.
better for the next 12 or 24 months.
Okay.
So I think the market is ignoring all the good news on its way, and it's
Okay.
just relentlessly selling due to the weak sentiment.
Okay.
And the funny part of the last 8 month cycle is the traditionally defensive sectors, right? Like
Right.
FMCG, staples, IT, or even pharma. These are the low volatility sectors. Historically, they've provided resilience to the portfolio. Even these sectors have been sold into. They've also borne the brunt of, tremendous selling pressure. You could partly attribute this also to the relentless FII selling. We've had 3 lakh plus crores selling since October, roughly 1 lakh 25,000 crores of selling in calendar year 25 itself. So I think large cap, while valuations are very, very comfortable,
Right.
we are vulnerable to FII selling.
Okay.
Despite that, I think investors should be better positioned in large caps or with a large cap bias.
Okay,
So
so
now,
that I apologize for cutting you off. We're a little sensitive on time right now. Just quickly
sure.
want to get one more view of yours on gold, because we have seen an unprecedented rally in gold right now. Time now to switch from equity to gold, make it bigger in your portfolio. Could you quickly just give us your view on that?
Sure. So we have roughly 25% allocation to gold in our multi-asset portfolio, not in our equity portfolio. And I think gold has a lot of near-term and long-term triggers, whether it's the weaker dollar, whether it's the geopolitical and economic uncertainty, and the global inflationary pressure. So I think gold is a relatively better asset class in times like these. And with a structural view of rates coming down despite the near-term delay, I think gold should be well positioned to provide some hedge into the portfolio.
All right, so that with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us.